Hello, everyone, and welcome back to Outspoken Market Global. Leandro Guerra speaking. And today's class, it's about a mean reversion model that you can trade based on the residuals of a linear regression. It's not complicated at all, and I will walk you through the 15 steps required for you to have this code that will be available at om-qs.com for free in the research blog, so you can download and adapt to whatever you want, to the asset that you enjoy, and then evolve from here. So it's fully functional. The point is, I'm selecting the SPY or the S&P 500 because it's very liquid. Usually, in many brokers, the fees are very low, and you will see that I will discount the operational costs in this backtesting that I'm going to share with you. So this is not something that it's just theoretical. No, this is something really, really interesting that you can, again, modify, adapt, and evolve according to your needs. Okay, so the key idea is the following: the market will do whatever it has to do. So we are not trying to catch or to really go under the ultimate precision for following a trend or detecting a movement. What we want to understand and to capture is a potential correction of an extreme deviation that we have between the actual closing and the regression implied close that we have estimated, right? So this is the key idea. And then you will buy or will go short depending on the signal that will be generated by the model. Now, the selling signal, the short signal, is if the current close is far above the regression estimate, the residual will be strongly positive. And in this case, we may identify the market is eventually or temporarily stretched and tends to get back to its mean. And the same rationale, but the other way around for the long, the buy signal. You will then install the the TradingView data feed library to collect the data. I'm using that particular broker, not because of any particular reason. It's just because the one I trade, and I think it works pretty well. The costs are very low, right? And for the SPX, SPY, S&P 500, this is the ticker US 500. So in this first function, that it's the key one that we call it run regression residual strategy, we will have as parameters the symbol, the exchange. We will be using the daily time frame, the last 5,000 days to do two things. One, training or fitting what the linear regression will be, and then the rest, the other 3,000 points they will come after the train size of 2,000, they will be for the testing purposes. You will add eventually another kind of split to include, if you don't want to do any paper trading, the out of sample. So eventually you fine tune the threshold, base it on the testing size or validation, and then you will take a piece of that for the out of sample if you don't want to do paper trading. But of course, I strongly recommend you that you do some paper trading for sure before any tests on real account. It's part of the job. It's something that you must be adapted to do so. And then we have also the trading costs parameters and the model summary that will be shown after the test of the regression. Why a linear regression? because simplicity works. You can eventually try for yourself any other type of a regression model, maybe a neural network for the regression task, or even a decision tree based model, something. But the linear regression one coming from the stats models, it's more than enough. Right, so here we have all the documentation of the function. No further explanations are necessary. The first step is download the data from the trading view. So if you already a subscriber, you can add your username and password to fetch real-time data. Otherwise, for the daily time frame, the let's say without credentials, you will still have reliable data. In this case, we get the historical data using the method getHist that will then store into the data frame that we call it DF, very creative. We have this piece just to validate that the trading view returned some data. Otherwise, you will get an error. Eventually, it's very rare, but it may happens. We may have a mixed or something wrong in the index of the data frame, meaning the dates. So we reset that index. We standardize for simplicity the columns names, and then we will keep only the columns required for the analysis. Eventually, we don't need the volume in this case, but I let it here in the case you want to test something else. Previously, this was a code that I did in Python R, sorry, several years ago. And by the time we had the Yahoo Finance library that they had the adjusted close. So here is already fitted for the trading view. So we no longer have that particular need in this case. We remove any kind of NAs that we have. We check if we have enough data for the requested training size. There are 2000 data points as we have seen. And in the case we don't have enough data, we must try to change the train size to something that will be suitable for our training in this case. Then what we are going to do? First, we will have a close lagged that we are calling in this attribute close lag. So we just take the current close and then you shift, put it back by one period. The next one, of course, we need the close lead. So the event that we will have in the future just to do the back test. Of course, on a real environment, you don't have the future information, but this is just to back test because I must calculate the return for the whole idea that we have over here. Then we just calculate a very simple percentage. By the way, the returns here, they will not be compounding. I will be assuming in the calculations I have that we have independently each one of the trades following the same amount, the same size of your position without any compounding of your account. For simplicity, you can add whatever you want. And the reason I do it is because there is none or no size fits all strategy for sizing, for risk management. So I keep it the way that it's the simplest possible so we can trade. Then we do something that it's really simple. If the return is positive, we have this return binary. So 1 for positive and 0 for a negative return. And that eventually it's the target that we have for our model, either on the continuous way, that it's the close lead that we had divided by the close. And if you are new to my classes, you will see that many times I am redundant in some of the things because I'm teaching people that they are not experts. They are not so familiar with all of those things. So if you know a little bit more of coding, you will study this to get the main idea, to get the algorithm, to have in your mind the trading system. But of course, the Python code can be further optimized. We are not speaking of a high frequency trading or anything else, so you don't need really to worry about performance in this case. You must understand the idea. So you then will be independent to build your own strategies. Target 1 and target binary, they are set. Then we simply split the data into training and testing sets. The first 2000 rows, in our case, for example, they are the training. And then we have another slice of the data set allocated into the DF underlying test over here. We store the date ranges for further reporting, so we can plot the charts and get some statistics of the model, as well when the test and the training they will start and end. And then we first print a clear summary of that spread that will be shown in the records. Now we fit the linear regression model. In a nutshell, we have a beta, that is the beta 0, the beta 1 that will multiply the closed leg plus the error of the regression. This is not a machine learning in a complex sense. It's a statistical relationship. And this can even be thought as an auto co-integration. So I'm testing a regression of the asset against itself like it, checking the residuals, and eventually those residuals, if they go over a particular threshold, up or down, we long or we short. I'm not applying any DK Fuller test or something like that for stationarity because it's not the case. You could, likely you will have this residuals stationary because it's your asset against itself. In some cases, we will not have, but again, this is something that you can, let's say, upgrade in the tests during your studies. To feed the linear regression with the stat models library from Python, you must add the constant term so the model can estimate the beta 0. There is the intercept of the regression, and then you call it all with the method OLS, ordinary least squares, where you place the training y, the training x constant, and then you fit. You will get the summary of the regression, get the parameters of the regression, so the constant and what multiplies the closed leg, that it's our main variable, so we can get the calculation later of the residuals, because we will use the beta 0 and the beta 1, meaning the intercept, and what we have called the beta leg, to have the regression line from our closes, and then the residual will be the current close minus the regressor 1. And this is what we are going to do the comparison as we describe it in the rules in order to determine what are the entry points to our model. We calculate as well the residual statistics for the training data to understand, and this is something really important. We don't use the testing data to create the thresholds, otherwise we would be leaking future information into the strategy. So we get the residual summary with the described method from the residuals that we have calculated for the training. And remember, we calculated the residuals separately for the training set and for the testing set. Here, on this step number 6, we may have two situations over here. One, what are the thresholds? How do I define the thresholds for buying or selling the asset? Well, I can do several tests on my own, checking out what would be an optimal number. That works pretty well. Or eventually I can establish a rule a parameter that will be followed regardless of the asset that will be eventually adding here. Why is that? Let's take, for example, Bitcoin. Bitcoin now it's 75,000. This is the order of magnitude. The S&P it's 7,000. Of course, the residuals they are not going to be on the same, dimensionality. The residuals for Bitcoin might be, I don't know, 400, 600, depending how good the regression is. While the residual for the S&P will be something like 40, 30. So, and then for each one of the assets, eventually you need to try out by hand, and we will do a test for different assets. Or I can standardize and say that, look, one clever way of doing that is to have the measurement of the first quartile and the third quartile and use those guys as the thresholds for selling or for buying the particular asset. And in this case, we can reproduce the logic from the original R code that I had built. These classes in the beginning they were done in Portuguese. And when I say years ago, I'm speaking maybe about 6, 7 years ago, something like that. And in school, because I was updating this for Python, and the strategy still works. It's amazing because simplicity works. So, for example, we may have a rule, the upper threshold, that will be that third quartile times 2. And the lower threshold will be eventually the first quartile times half. And these numbers can be eventually parameters as well that you can fine tune to have that standardized. And not only as an idea for your future studies is what if I have a moving threshold? I can apply then a moving average to these thresholds, should not be static, especially because, and this is the right thing to do, the magnitude, again, the dimensionality of the asset will be different throughout time. And here I'm using the most, the simplest way possible, because if that works in that way, any optimization I do, of course, will work even better. You understand what I do? So I stress not the parameters themselves. What I stress, it's the idea. Because if that works, if there is any sign of the strategy being profitable without a huge level of customization, likely if I apply any level of customization, then things will be even better. I don't trust entirely optimization because we may have overfitting. I prefer do a little bit more of a rudimentary way and then fine tune, then already start fine tuning everything. And I strongly advise you to do the same. Then we print actually these summaries and these thresholds. We also plot the training residuals in a particular chart on the step number 7. And please, if you are not getting these technical terms, or eventually you are not so familiar with the linear regression, with all the things that I'm commenting, and if you want a class that it's yet a step back from this, a step before that, let me know in the comments or in our Discord community that I'm more than happy to prepare something specific for you. I do have some assumptions that you have some familiarity with Python, and at least you know what a linear regression is, even without being an expert. You don't need to be an expert to follow this code and the things that I'm doing. So we plot the residuals, so we get them. We plot for the training piece, and we use Plotly because it's a nice framework for building the charts. We show them. Then in the step number 8, we apply the residual rule. That is the simple rule of manually setting what the threshold will be. And then remember, if the residuals, they are above a particular threshold, we get a signal that is minus one, meaning that we will short the asset. And then if the residual is below the negative threshold, then my signal becomes one, and that one means that we will long the asset. And if it's not the case, so if I am in between the thresholds, I will do nothing. I will stay out of the market. I then apply the trading cost only when I have a trade, of course, but that needs to be, of course, it has to be said. And then the strategy return. As I said, signal plus one, the strategy return, it's the next one minus the cost. If the signal is minus one, then we multiply that particular signal for the what we have as the return. And then we simply do a cumulative calculation of that, a simple sum. And then we also have the table comparing the future market direction with the model signal. So we can have a percentage table with comparing the rules with the target and the rule itself, so we can get an idea of the accuracy. Although the accuracy is not the most important thing, because you may be profitable even with lower accuracy, because if you win a lot when you win, that will for sure compensate the many times that you may lose, but you will lose small. Then we plot the simple rule cumulative return, and then we do exactly the same steps again, but for the quartile residual rule, the one that we did with the Q3 times 2 and the Q1 times a half. Again, you may decide to change these values as well, or do something that it's moving. And then I calculated the accuracy. We plot the comparison of the charts, and then comparing the cumulative return of the quartile strategy and the simple rule strategy. And then we have also in the step number 14, the diagnostic chart that will help to explain the model visually. So you can see how close the linear regression was fitting the actual close that we had for the asset. Honestly, this is a more of a makeup than anything really useful, but it's cool to see. So we are gonna check it. And then the final one, it's the final performance. So we get the whole summary over here. This, there is nothing complex here. It's very basic Python methods and libraries that we are doing. In quantitative trading in general, my friends, the whole idea is not that you are the god of coding and the god of modeling, that you know very complex stuff. There is its place. This thing there has its place, but you can also be very good enough for yourself following something like that. And then with time, you will augment the complexity if needed, only if needed. And then the last step, it's not regarding the strategy itself, but it's just for you to have separately the elements that we have calculated in the case you want to do a particular analysis, and how to use that. So this is run. I already run it before, but if I clear the outputs, let's run again. And then I will run our function that it's composed from all of these 16 steps that we have seen, from which 15 are the strategy itself, or they belong to the strategy itself, sorry. And we get the symbol, we get the exchange, the daily interval, 5,000 bars, 2,000 for the training size, 20 for the threshold, manually in this case, the trading cost, being that low, because in particular that broker is low, and then I show the summary. When I run it, you see all the prints and plots that we have set. The dataset information, so the training records, they are coming from 2006, September 21st to September the 2nd of 2014, and the testing it's everything after that up to the 27th of April 2026. This is just the summary of the regression. Of course, the R squared is going to be very high because I mean, the regression it's against the lag of the signal that we have. So I do not expect anything different in this case. The coefficients, so the intercept is 0.7 and the beta close lag it's 99, 97, 32. So very close to 1, demonstrating that we have a very high dependency or level of explanation of the current close by the previous one. Then the thresholds that we have set. So the fixed upper threshold is 20, the lower it's minus 20, and then the quartile ones are based on the rule that we did. So if we plot only the residuals, that is the first plot we did, we are going to see something like that. You see these dashed lines in black, they are our threshold. So if I pick up, for example, this point over here, so on October 28, 2009, we had the residual going above the upper threshold, triggering, in this case, the short rule. Another example would be, I don't know, if I pick up here on January 21st, 2010, we got a long signal, and this all the way through our data frame. And then here is our table with the comparison. So you see that most of the time we are out of the market, which is pretty cool. You don't need to trade daily all the time. If you have time, then you can even lower the time frame for something intraday. Otherwise, we can have that way. And this is the nicest part. This is just the testing part. Discounted the operational cost in this case, we see that we have a very decent result. Ah, Leandro, but this is not beating the buy and hold and etc. Maybe not, but that is not the case. The point is, I'm not trading all the time. I'm trading less than half of the time. I'm not exposed to any particular problem, economic, macroeconomic, war, and etc. I may have my drawdown periods, but again, this is a very simple model. But the point is, you see, this very simple model works already discounted the operational costs. If we do the comparison with the quartile rule, you see that, well, in some cases it was way better. In the overall scenario, it wasn't, but there will be assets. So if I use here into the VIX CFD, you see the results, they are much smaller because the size of the VIX in comparison to the S&P, I mean, it's much smaller than that. The simple rule has triggered nothing. Eventually, I have to adapt. But you see the yes, it's the VIX. It's amazing. And so you see the quartile rule works. Now I may come over here and then I can fit a particular threshold. I don't know, let's put 2 so you can see a difference. So you will be triggering few particular trades over here, and then you already have something pretty cool, right? Again, I am out of the market most of the time. 90% of the days I was out with the quartile rule, I am in half of the time. This comparison, by the way, maybe not be the fairest one, because if I go back to the US 500, you will see that in the quartile rule, I was out 35% of the time, one third of the time, while in the simple rule, so a fair comparison, I was out more than half of the time. So a fair comparison would be what is the cumulative return in comparison to amount of time that I stayed in the market. So eventually the metric might be slightly different, right? Of course, depending of the asset. So coming back to the VIX, so we put the VIX, I come back to a different threshold. So you see that the result, it's also changing itself. It's amazing. And now you have everything to play around, to try it out, optimize, change, do your tests. But you already know in a single class, half an hour, what to do to start your quantitative finance life. This is just an example on how eventually you can get the information from the results generated by our function, apply them in different data frames, and have that analyzed in an eventual way. And then if you want to do an analysis with another asset, you need just to come here, run the regression again. You will see that you can change, you can play around, and then you don't need always, so you can keep a track record of testing on different assets. So here I'm doing Bitcoin 4 hours, and you see it's suggesting some of the thresholds. It gives you a positive return, okay, with some aggressive drawdowns, but again, we are not optimizing anything, either on the quartile rule or in the simple rule, but just to show you how everything works. Something that I forgot to show you was the comparison of the regression and the close of the particular step. You see, the regression, it's always is likely lagged in comparison, which makes sense. But if you want to take the overall overview like we are doing, you can do. And from here, food for thought, you will see that, well, we can have this kind of algorithm to try to predict the trend, never the price, but the trend. But this, it's a subject for another class. So, my friends, I hope you have enjoyed this class. Go deep in this code, study it line by line. Again, it's available for download. If you have any questions or suggestions, let me know. And I'm really hoping to see you in our next class. So take care. See you there. Bye bye.